Okay, what's up? Welcome back to the vlog. It is a little bit windy, so forgive me in advance for that, but we'll try to work around it. Okay, so today is going to be chapter 5, Tools of the Trade. We actually read a whole chapter, I believe, the last time we did this vlog, which was pretty cool. So it talked about what to trade, and so now we'll talk about tools of the trade. All right, let me get like good and comfy. Tools of the trade. All right, there are several requirements for day traders before getting started in the profession, ranging from having enough time and money to having the right kind of brokerage account. While it's possible to dabble in trading without some of these things, such as sufficient starting capital, doing so is usually unsustainable and may result in quick losses. The key to success is practicing paper trading with a demo account using the same tools as you'd be using in a live account, and then slowly transitioning to the live account with adequate capital and the right tools in place. In this section, we'll explore some of the core tools necessary to getting started on day trading. Money. Money is the single most important resources for day traders. Without adequate funds, traders must take on more risk to realize sufficient returns. These risks translate to lower risk-adjusted returns over time as costly mistakes eat away at returns. Day traders should try to maximize their available funds. In order to reduce these risks and improve their risk-adjusted returns, taking into account that stretching a personal financial budget entails its own problems. By committing a high percentage of their total net worth, day traders risk increasing their emotional investment in the venture. Such emotional investment seems like there should be an S on the end of that, but could be detrimental to trading performance. The reasons for which we have discussed earlier in the book. When more is at stake, day traders are more prone to making costly mistakes. These mistakes can be avoided by ensuring that only a comfortable portion of the total net worth is invested in the venture. Aside from their cash investment in the venture, day traders have access to many different margin opportunities. Depending on the market they're targeting, most stock market brokers provide leverage for up to 50%, which means that a day trader with a $50,000 account may actually have access to $75,000 in trading capital. When margin is used, the trade is charged an interest rate on the borrowed money, and the broker may issue a margin call when the margin posed in the account is below the minimum margin requirement. The law requires that equity market day traders maintain a minimum $25,000 account balance at all times, but many other markets do not have the same limitations. For instance, day traders can start with as little as $100 in the Forex market, which can be leveraged at 100 to 1 or greater to effectively trade with $10,000 worth of capital. It's crazy. The trade-off is that the leverage entails greater risk. If a $10,000 trade loses just 1% of its value, the broker could issue a margin call and the day trader will lose his $100 investment. Many proprietary trading or prop trading firms provide day traders with an alternative source of capital in exchange for profit sharing and adhering to other conditions. Prop traders have access to a limited amount of institutional capital in addition to their own capital. Margin. Suppose that you're playing poker at a casino and are running low on funds. With your luck starting to turn around, your friend decides to spot you an extra $100 to stay in the game, provided that you give her $125 in return. Your luck does start to turn around and you end up pocketing $500 for the night, even after paying your friend back the full $125. In that case, the borrowed money helped facilitate the profit, but it could just as easily have led to a loss that was amplified by $125. A loss that was amplified by... It's like the dog doesn't like to hear about the loss. Led to a loss that was amplified by $125. These dynamics are similar to margin trading. Margin is an important concept for day traders to understand, since it's both required for pattern day traders and highly useful for leveraging trades. If used properly, margin can help improve profitability by using borrowed money to trade. The catch is that the margin is a double-edged sword and can quickly compound losses if used improperly. Since day trading involves capitalizing on small and rapid price movements, margin is a tool that nearly every day trader will need to familiarize himself or herself with over time. Margin mechanics. Day traders have access to up to 50% margin when trading US stocks within a margin account, meaning they can borrow up to 50% of their account value. After making the purchase on margin, traders can keep the loan as long as they would like, provided that the obligations including repayment and interest are fulfilled. The loan is repaid in full when the position is sold, before any of the proceeds are distributed to the trader. The biggest risk associated with trading on margin is the dreaded margin call. Within a margin account, brokers require a minimum maintenance margin or minimum account balance to be maintained. Otherwise, they force a trader to either deposit more money or sell the stock to pay down the loan. The minimum maintenance margin required by law is 25%, but individual brokers may have more specific requirements. A margin call occurs when the broker demands additional cash to be deposited or the securities to be sold. A final important consideration is that over time, interest accrues on margin. Hence, the break-even point is constantly increasing. Usually accrues as a payable on the account. Traders may make the payments in cash to brokers if they so wish. These dynamics mean that margin accounts are usually only practical to use for short-term traders, like day traders, rather than long-term investors. Advantages or disadvantages. There are many advantages and disadvantages to using margin. To illustrate these examples, let's take a look at two scenarios showing what happens when margin has a positive effect and what happens when problems arise. First, let's look at how margin can help to improve trading performance. Suppose that a day trader wishes to buy $5,000 worth of a stock that's trading at $10 per share, with a price target of $11 per share. If the trader simply used his own capital, the trade would produce a 10% profit, or $500 on a $5,000 investment. The trader could improve these performance metrics by trading on margin. If a broker provides up to 50% margin, the trader could borrow $2,500 and use only $2,500 of his own capital in the trade. These dynamics would equate to a $500 gain on a $2,500 investment, or a 20% profit. A 20% profit, where the other $2,500 in the account could be used in other promising trades. Now let's take a look at risks associated with trading on margin. Suppose the same day trader buys the same stock, but instead of increasing to $11 per share, the stock falls to $9 per share. In this case, the trader lost $500 on a $2,500 investment, or a 20% decline when using margin. The bigger problem occurs when a broker decides that the trade is too risky and demands to be repaid in what's known as a margin call. When this occurs, the trader must either put up the additional margin, in this case $2,500 in cash, or the entire position will be sold for a loss. The latter scenario can lead to significant losses, particularly when the day trader can't afford to put up the extra margin. In the end, margin is an invaluable tool that day traders can use to amplify their gains, but they should be careful when using it, since it's a double-edged sword in many ways. Time. The only other major requirement for day traders is time. While some retail day traders try to trade part-time, those looking to achieve the highest chances of success should consider committing to trading as a full-time profession. There are many different ways to go about becoming a full-time day trader, including working for yourself or someone else. Would-be day traders should carefully consider the options before deciding what is best suited for their situation, and set themselves the right expectations from the start. Part-time versus full-time. A key decision that novice day traders must make is whether to pursue day trading as a full-time or part-time job. As a part-time job, day trading may involve trading equities on certain days off, or trading currencies during non-business hours. A great example may be someone who enjoys trading on his off days in order to make some extra money. Given the high starting capital requirements in some markets, like US equities, these traders may focus on futures or other markets that are less restrictive and or have longer hours. The trade-off is that the part-time day traders shouldn't expect to make as much or perform as well as full-time traders. As a full-time job, day trading involves working from pre-market to post-market hours and perhaps longer, in order to obtain returns sufficient for sustaining a decent quality of life. An example would be a day trader who takes a job working at a prop trading firm in order to learn the ropes, and then slowly begins to trade his own capital over time as he is able to pay the bills and generate more consistent returns. The trade-off is that full-time day trading is a very difficult and risky job that's much more difficult to master. Alone versus prop trading. A second decision that must be made is whether to join a prop trading firm or venture out on your own. With access to institutional capital and educational resources, prop trading is an attractive way to get started in day trading. without the high capital investment. The trade-off is that a large portion of profit goes to the prop trading firm, and there's sometimes other costs involved with working at these firms, such as commission and educational fees. Some firms even charge day traders to become involved. Traders should do their research on a firm before taking the plunge and joining them. The decision to go at it alone has its own advantages and disadvantages. With the significant upfront capital cost, day trading can introduce a lot of financial related stress into someone's life, and it's quite difficult to master. The obvious advantages are that the trader controls his own destiny, doesn't have to pay out any profits to third parties, and ultimately profits the most from his own performance. Direct access trading. Direct access trading enables day traders to transact directly with exchanges rather than going through intermediaries like stockbrokers. With a direct connection to exchanges, these accounts benefit from faster transaction speeds, reduced slippage, and reduced expenses compared to traditional intermediaries. The accounts may also permit day traders to route their own orders to specific market makers to achieve desired outcomes. The average direct access trading account pays a commission based on the number of shares traded rather than the number of transactions. In the equity market, these figures amount to around 0.005 per share, which is significantly less than traditional stockbrokers that may charge $9.99 for a single trade. Scalpers or other day traders that trade greater volumes of stock may also qualify for further discounts from these rates. Direct access trading accounts usually require a minimum investment that varies depending on the provider and a minimum activity level. For example, a broker might require a $10,000 minimum to open an account, and then at least $30 per month in commissions to avoid monthly fees. If the minimum activity isn't met, day traders may face inactivity fees or other consequences. Novice day traders should also familiarize themselves with the many differences between traditional brokers and direct access trading accounts in order to avoid any accidents or errors when trading. All right, I think that's good for today, and we'll open up with business plan the next time. Cool, thanks for joining.